Hello there, financial sleuths. How you doing? It's a theatrical business class, so it wouldn't be appropriate for me to run it without props. So, how you doing? This is the third of the lectures on financial management, the third and final one. And so we'll go through the case study today and a couple of other housekeeping things, and then we'll adjourn for the weekend, and then I will assign you a whole bunch of reading to do. So that should be fun. Um, so let's get started. So last time we talked about, first off, the role of the financial auditor, which is to assess the company and its financial transactions. We also talked about internal controls and how it's important to have internal controls, like where you're segregating financial duties, writing down policies and inventory lists, having insurance, having a conflict of interest policy, which is extremely important, and how that makes the role of the auditor and the arts administration manager a lot easier. We also talked about the financial statements, the balance sheet, which shows your assets and your liabilities and also your equity, the income statement, which shows income and expenses, and the statement of cash flows that allows you to follow the money very, very carefully. And then the concept of articulation, which is how all of these financial statements interrelate. How's that numbers from the balance sheet? They start off the new year. You take the ending numbers from the previous year and plug them into your statement of cash flow and your income statement starting, and then the ending numbers from those get plugged into the balance sheet. So it's the circle of life, the circle of financial life. So today we're going to go through the case study review, and also we'll do some additional considerations for looking at the financials of a company. The indicators, there are 6 indicators of financial health that we will step through. And but first off, let's get started with the case study. All right, so I hope you guys had fun with this. I know it was, a little bit different to be looking at a sheet full of numbers and trying to make some sense out of them. But, I really do like figuring out what the story is just based on numbers. So let's step through these 7 questions. The first one was pretty easy. What are Child's Play Theater's fiscal year start and end dates? And you can tell those pretty quickly. They are July 1st to June 30th. This is kind of standard for a lot of theater companies. Why do they start in the middle of the year? Typically, that coincides with how they break down their theatrical seasons. It's just easier that way. But you can see that on the statement of financial position and on the statement of activities, they note that the end of the year is June 30th, 2000, and well, this is 2000 and whatever. And so if that's the end of the year, then the start of the year has got to be July 1st. Yes, and that's my note that I just told you. So there you have it. Number 2, how much of Child's Play Theater Company's operational expenses were funded from donations? Now, this is a little bit of a tricky question, but only because it has the phrase operational expenses in it. So, you would think, oh, well, okay, I've got to look at the operational expenses on the P&L. But you don't actually. You can see that from the P&L we had a net loss of $11,367, and but then looking at the donations, which are on the balance sheet, you can see that we had $11,367 coming out of the fund balances. So, and those are donations, fund balances, unrestricted funds, and temporarily restricted and permanently restricted funds. So the correct answer to this question was 11,367. The money had to come from somewhere, so in order to fund the operation, so they took it out of equity. Now, here's a little bonus question though. Where else could the money have come from? Oh, wait a minute. No, I won't wait a minute. I'll just tell you the answer. The money comes from assets. Money comes from the balance sheet. So it could come from the equity, but it could just as easily have come from liabilities. We could have borrowed some money in order to cover the shortfall, or we could have sold something. We could have sold an asset. But as long as the balance sheet remains in balance, then we're good. All right, so let's move on to question 3. What were 3 reasons that Child's Play Theater Company was short on revenue? So this question asks about revenue, right? So you know that we talk about revenue in the income statement, or the statement of the profit and loss statement, or the statement of activities in this particular case. So there are, I came up with a couple of reasons. The first big one is revenue's down because we had slow ticket sales. That one's pretty easy. The other possibility is the touring production. It didn't do nearly as well as we had hoped. Now you have to wonder why that is. Now there's actually a note about that in the on the budget, but at this point, if we're just looking at the income statement, you can guess, well, maybe they didn't market it enough. So that's a possibility, but we will actually find out the real answer in just a minute. They also had a pretty low turnout for the holiday gala, and there was another question about that coming up. So they didn't get enough people coming, so they didn't get enough donations from that, or they didn't or sell enough tickets to it. Now, and also looking at the unearned income section, their donations and their grants were a little bit low. So donations were down 18%. No. Yeah, so the donations were down 8.3% because we saw in the previous slide we had some loss of the donations due to cash being converted. We took money out of the fund balances, your donations, in order to actually pay for operations. So some of this loss is just coming from that. And grants themselves, though, these were down about 18%. So I have to wonder about that. Now, the good news is that the gift sales, all right, so moving on to question 3. What are the 3 reasons Child's Play Theater was short on revenue? So this question asks about revenue, so you know that is going to be listed in the income statement, or the profit and loss statements, or the statement of activities in this particular case. So the 3 big reasons that I came up with were we had slow ticket sales. Obviously, those were down quite a bit. The touring production, whatever that is, didn't do as well as we had hoped. Now, there's actually an answer for that later on in the balance sheet, but right now we're just going to guess maybe it wasn't marketed enough. They had a very low turnout for the holiday gala, so they weren't able to sell tickets or whatever they were trying to do for that. They also had some their donations, or excuse me, their grants were down 18%, and I have to wonder why that was. Maybe there wasn't somebody fully dedicated to that, or what. Donations were only down about 8.3%, though. This is kind of a bigger number, but remember that some of that loss is due to the fact that we pulled cash out of the fund balances in order to make sure that the season wouldn't, that we were at least, that we mitigated our loss a little bit. Now, food and beverage is also negative, but I don't count that as a primary reason for why they were short on revenue. If you look at this percentage decline is only about 2.7%, whereas the ticket sales decline was significantly more than that. So if If concession sales were solely a product of the number of people in the audience, I would expect to see that the same percentage. But since concessions was significantly less of a drop, somebody's doing something right in the house in order to make sure that we're generating money from concessions. So that's good. More good news is I see the gift shop sales were up. And the membership revenue is also up a little bit, even in spite of the fact that we had low ticket sales. So something's going on there. Something good is going on outside of the actual theatrical production. I would say maybe we've got some really good community support if we're selling stuff in the gift shop, and we've got really good house management who are selling memberships and that sort of thing. So. Maybe they've raised prices. That's also a possibility. But, my takeaway from this is people are generally happy with the theatrical experience that they are getting in total. So moving on to question 4. Why didn't the holiday gala perform as well as expected? Well, for that, I'm going to take a look at the proposed budget. Because sometimes budgets are not all about the numbers. There's generally some notes in there that will give you a clue as to what is going on in the financial statements. And you can see here the reason that the holiday gala didn't perform well, it snowed. Snowed out. Or that kept a lot of people from showing up. Also, we were talking about the touring revenue and why that was short last year. It looks like for some reason there was a library tour that didn't happen this year, and it's been rescheduled for this year. So question 5 asked us, what did Child's Play Theater do to compensate for the revenue shortfall? Well, if you don't make enough money and you need to minimize the impact on your savings, or you don't want to call Aunt Edna for money, you got to cut expenses. Now, in the expenses column, negative numbers are always bad, and big positive numbers mean that your department heads really had to make some difficult decisions in all of this. Expenses, as you know, are on the P&L statement or the statement of activities. So digging in here, what did they do to compensate for the shortfall? Hats off to the production department, really. They figured out that if they spent maybe a little bit more on scenery, maybe built it more efficiently, or built it with some angles that would save on lighting, but they put a little bit more money into that so that they would distract from maybe their older and their borrowed costumes. There's actually a note on the proposed budget about costumes also. So they really did a good job of cutting costs there. Another thing that I see that they did is they implemented some austerity measures. They got tighter controls and justifications over what they spend money on. You can see these other line items, especially in the marketing department. They don't spend anything on the other. They reduced their reliance on contract personnel. So, they saved a bunch of money there. So maybe they had the staff, do a lot more than they had actually intended to do or were expected to do. This contract personnel is probably temporary workers. But the biggest hit, the biggest improvement, I think, came from marketing. They really took a lot of marketing took the biggest hit. Their original budget was about $73,000, and they only spent about 47 of that, which is interesting. I'm a little worried about that. This is kind of dangerous, especially considering the good feeling that we saw that the community has for this theater based on the other revenue that was being taken in at their productions. And I'm a little worried that they're doing a lot of mailings too. They're still spending a whole bunch more on mailings and printing than ever. And in this day and age, maybe that's not the way to go. So, question number 6. Are there any expense items that seem to be missing from the proposed budget? Hint, check the balance sheet. So, if we look on the balance sheet, if we follow that, that hint, I see that there's a note payable. And if there is a note payable, and that is, again, one of our short-term loans from Aunt Edna, there should be some interest being paid on it. So I would expect to see that in the administrative expenses. I would expect to see interest paid. Now, here's another note about the expenses section of the budget here. You can see that all of the COGS, what we've traditionally considered to be COGS, are they're putting in as these artistic expenses. So all of the COGS are listed under 2200 artistic. You can see also they've got their artistic salaries listed under personnel, guest artists under personnel. So that's how they've organized them, but they're definitely there. Also, the astute among you will notice that the budget lists website under marketing, but it's labeled promotions on the P&L. So that was a typo, just a slight one. And finally, question 7. Is there anything you would change in their budget for next year? Now, as long as you back up your answer with some numbers in the P&L or on the balance sheet, there really are almost no wrong answers here. What I see is that they are expecting their downturn in ticket sales to continue because they're only expecting $570,000 worth of revenue. And they're taking that out of ticket sales, and everything else is kind of dropping. And I think they are hoping to slow that by just marketing to their base, who are older and they are used to getting postcards in the mail and flyers. So they're just hoping to kind of manage this decline. When you construct a budget, you want to think about how to incentivize activity in certain areas. You can add funds to particular line items in order to incentivize the activity there. And that's what they are doing in the marketing section here. So I don't know that I necessarily agree with that. So a couple of things that I think that they could do. Number 1 is add more royalty-free shows to the season. It looks like that will reduce their license fees. Let's see, that is... Where's license fees? There it is. So you see where it says no royalties for original play? I'd say they do more of that, and they can shave a couple of $1,000s off of each production. That's one small thing they can do. I would also bring their marketing budget back up. Marketing is going to be crucial. And even though it looks like the current marketing director has had success in driving ad revenue, you can see that this number, the advertising number has actually was over budget last year. So obviously the marketing director knows how to sell ads in programs. They are not fully making use of their website and their online budget. You can see they only spent $2,300 of their website budget. So I think they need to increase that marketing budget, and maybe it's time to cycle out the marketing director. If they need to go after a new audience, they may need a new person who is equipped to speak to that audience. I would eliminate the cost of living increase for the administrative staff. That'll shave about $3,000 off of there. It is definitely belt tightening time for this theater. And it's time to start thinking of some other ways to make revenue happen. And so with all of those savings, we've already shaved quite a bit of expenses out of the budget. They've managed to, last year, they were budgeting for a total 0 net income, and now we're actually, this is, I think, pretty aggressive to think that we're going to make $32,000 when we only made 0. But what if we took that money and the money that we saved from the cost of living increases and brought on a development director? We've already seen that they've had a drop in their donations and their grants. So I would suggest increasing maybe the contract personnel number, or maybe if we bring somebody on full time, so we can increase the administrative salaries to go after those donations and fill out those grant applications. I think that is how you could incentivize some activity that would bring this company in the red or into the black quite a bit more than just optimistically slashing costs and expecting the worst. So we've just looked at some financial statements, and I think you guys did a pretty good job of this. I know it's not something you're used to doing, but we identified some areas where they could change. We looked at some information to figure out where it is and what it looks like. But there are 6 indicators of financial health in an organization that we can generally discern from looking deeper at the financial statements. So here are some benchmarks that you should be looking at. First one is that we have enough funds to meet current obligations and upcoming commitments. We did a little of this when we stepped through the statement of cash flows in the last lecture. But what you'll see is if you do that long enough, and if you look back for a long enough period, you will see definite cycles in the period. So for instance, this is a company that does a lot of work in the summertime. Their summertime productions are pretty good, and then they've got enough cash to get them through the next year. Different theaters may have different cycles, but periodic dips in cash flow may just be completely normal. But as long as they have enough funds to meet their current obligations, that is good. Number 2, this is another good rule of thumb. Have assets valued as at least twice your liabilities. This is a generally accepted rule in business. If you have enough cash to pay your bills and cover your liabilities should they get called due, you're generally in pretty good shape. One thing that you want to look at, though, in your assets is what the asset makeup is. If you have a lot of, remember, current versus fixed assets, current can be easily turned into cash, whereas fixed take a little bit of time. You could conceivably be building rich but cash poor and not able to meet your financial obligations. So, one good example is if you see a lot of cash tied up in inventory here. We've got a lot of lumber and a lot of costume material here, which is fine if you're here in 1 year, if you're getting ready for your season and getting ready to build sets, but not so good if you're coming into a time when you're going to need to pay actors. A third indicator of good financial health is that an organization has diverse income sources, and we talked about this last time. If you have money coming in through ticket sales and grants and donations and your education programs, that reduces the risk of loss if something happens to one of those sources. Or, for instance, what if the summer season rains out? What if the major donor moves? What if we have an epidemic that we have to deal with that wipes out our ability to actually do shows? So a diverse income sources is important for financial health. Number 4, have an appropriate mix of artistic versus administrative expenses. Now, in the budget exercise that we did, the idea was that we wanted to keep a 50-50 mix between your COGS and your admin costs. That's appropriate for most theaters. Depending on what type of organization we're dealing with, though, you can kind of play with that. So, for instance, a volunteer community theater might have, you're not going to have as many administrative costs because you're not going to have a lot of people who are getting paid for the time they are getting to make the theater happen. Similarly, with a straight-up production company, if your sole business is producing theater and you worry about somebody else figuring out where they're going to host it and where they're going to make money off of it, then you're going to spend a lot more money on your productions. If you are that same theatrical venue who's bringing in production companies, you would probably spend more on administrative costs. If you deviate from the 50-50 mix and you're not one of these types of organizations, just know the risk. You want to justify your decisions if you're going to deviate too far from that. And there's another good reason for that on the next slide. Number 5, your financial actuals should match what the budget is projecting. In the Child's Play theater scenario, you saw their proposed budget, or their actual budget, excuse me, their statement of activities was a little bit off. Now, for 1 year, that's fine, and you can see that Child's Play they had a snowstorm, they reacted fairly draconianly to slash their marketing budget, and their production team worked really hard to chop some money out of their expenses, so that their loss was not too bad. So if something dire happens in a particular year, that's okay. If it persists for more than a couple of years, then there's something a little bit off in the way that this organization is budgeting. And then finally, this kind of goes back to item number 4, the appropriate mix of expenses item. But basically, you want to make sure that the nonprofit mission is being protected. And what is the nonprofit mission? To serve the public trust, to protect the innocent and uphold the law, just like RoboCop says here. So if we are taking in public money, it should be going to quality programming. So is the public benefiting from the programs that the theater is putting on? This is the question that you need to ask. If the answer is yes, this is a healthy organization. But if, again, we're spending a lot of money on administrative tasks when we're taking in public money and not putting on good theater, that's something to watch out for. So even the most well-managed theaters, though, they go through hard times. And it doesn't mean that they are not well managed. I got an email on last Thursday from Timothy Locklear at NRACT outlining the scope of what COVID-19 is doing to them. So then they went through a pretty detailed analysis of what is going to be happening to their income statement. They have monthly operating expenditures of $9,650. Now, your experience with putting together P&Ls tells you where that number goes on the sheet. If the theater closes for 4 months, the cost is $38,000. If they close one of their productions 2 weeks early and they have to cancel their classes and not produce Young Frankenstein, that's going to cost $19,500 in revenue. If they can't produce Calendar Girls, they lose another $6,000 in revenue. If they can't do the annual summer camps, they lose another $45,000. So this kind of gives you an idea of how their P&L is structured. I will send you this email that you can peruse at your leisure. And for extra credit, now that you guys are experts in budgeting, if you want to estimate their income statement, I'll throw some points your way for that. You can send me another spreadsheet. And that will wrap it up for our lecture today. There's a review quiz up on Moodle, so take that, and it's going to cover what we talked about today and on Wednesday. And then on Sunday, the budget analysis is due, and we will put finance to bed for a little while. You've also got a lot of reading to do this weekend, so brew up a pot of coffee. We're going to dive right into marketing starting next week, talking about marketing the theater and shows and different kinds of promotional materials that need to get produced. And then on Friday, Danny DeCito is going to talk with us about what it's like to manage the marketing department of a large regional theater company. We will also have some questions. I will ask you guys to come up with some questions based on your reading, and that'll be an assignment on probably Wednesday, or it's due on Wednesday. So have a great weekend, and I will see you next week.